The mutual fund industry has grown by leaps and bounds over the last couple of years. It's been a phenomenal time. Assets of the industry have now crossed 50 lakh crores. Many funds have done phenomenally well. Stars have emerged, others have actually gone down. But there's a singular phenomenon in the industry, and that is one mutual fund from being a very small-sized fund 3 years ago is now one of the giants of the industry. I'm talking about Quant Mutual Fund. With assets of about 500 crores in December of 2020, the size is now 100x. Actually, more than that, 53,000 crores to be precise. And we are sort of coming to you from the floor of Quant Mutual Funds' office here in the heart of Mumbai. And with me is the man who's made all of it happen. Sandeep Tandon is founder and chief investment officer at Quant Mutual Fund. Sandeep, great to have you with us here.
Thanks.
Thank you very much.
Thanks.
I mean, I think our viewers and everybody just wants to know, simply put, how do you do it? It's a simple question, but not a simple answer.
Okay. So let me start with saying that, see, over a period of time, we have groomed certain things. We have started looking at a one-dimensional approach. Somebody says, I'm a valuation analytic. Somebody says, I'm a chartist. Somebody says, I'm a macro guy. Somebody says, I do something like this. Okay. But then we realize in last 30 years of my experience in the market thing that this is not effective way. We have to look at multi-dimensions, okay? Because one data points can be skewed. See, ultimately, in everything in life is relative. So absolute numbers are important, but relative numbers are more important. So when we talk about, give you a small example. In today's world, everybody talks about valuations are rich. And what example we'll give, we'll talk about 2000, we talk about 2007, 8, we talk about 17, 18. Yes, I agree, is rich. But if you look at in one dimensional, that is purely looking from the valuation point of view. But what happened to the liquidity aspect? Okay, when COVID happened, market rallied, let's say for March 2020, by September, everybody says this is a liquidity-driven rally, tsunami of liquidity. So liquidity analytics also plays a very important role. So if I look at what was the situation, let's say in 2000 liquidity, the global liquidity versus today, today global liquidity is more than 170, nearly $180 trillion, which is 2 times of the global GDP. Okay, it is few hundred times of that number what was in 2000, and it is few times as compared to 2007-8.
So you're saying that liquidity supports a much higher valuation.
Also, okay, and then you look at the sentiments. Okay, and the sentiments is very different. 20 years or 30 years back, India was very different. Look at from a perception point of view. Today is India's moment. We have arrived. I always say in my 30 years of my career, I have not seen such phenomenal macro. Both if I look at from absolute perspective and relative perspective. In fact, absolute is good, but relatively it's extraordinary. When whole world is going through a difficult phase from a geopolitical, look at the political stability in this country.
How do you quantify? Do you quantify sentiment?
Yeah, we do quantify. Okay. So it's
I'll come to sentiment. Yeah. So there is valuation.
Yes.
There is liquidity.
Yes.
There is sentiment.
Yes.
What else?
Okay. This is a 3 important parameters which we look at. This is what we call the valuation analytics, liquidity analytics, and risk appetite. We give 1/3 weightage to each.
Okay.
And then is the most important element is the time analytics. Okay. So time is a function of, when I say time analytics is a function of these 3 analytics.
Okay.
So in turn I can drill down further.
So just one thing, when we say sentiment, right?
Yeah.
And you quantify sentiment.
Yes.
So when we look at charts, for example, don't charts give us that? I mean, people look at charts exactly for that, right? Where is the supply? Where is the demand? Where are the extremes?
So
isn't
chart,
that?
if I look at the technical aspect, is one small form of it. There you can say at this price point, extraordinary volumes are there. So the next time you look at the psychological barrier, if these barriers happen, and it is accompanied by much higher volumes. So obviously, in the previous supply which happened, will got absorbed, and now it's moving to the next level. So up to certain extent you can call it, but we don't depend on the technical analysis in that sense. Mathematically, if I look at any data point, whether it's a Fibonacci series or exponential series or any data point, ultimately, as a mathematical firm, we do look at cycle analytics in a big way. Cycle analytics is part of, along with our money flow analytics, when we look at, we do look at these data points, but we define in a different way. Not just, technical analysis could be just a very myopic view. But yes, sometimes it gives you a perspective. Answer is yes, we do, can we ignore it? No, we do capture that, but we capture through mathematical route rather than capturing through graphical.
And what you called valuation, that captures fundamentals.
Yes.
Right.
1/3 is hard code valuation, okay, cash flow analytics which we do. But our advantage is that when we look at data point, we don't look at the forward. Okay, the entire industry looking at 3 years forward. We work only on the trailing because instead of looking at the P multiple is something we have built called perception analytics. The advantage of perception analytics, it is backed only on the previous data. When you bring anything which is forward looking, obviously there are challenges because forward looking statements are always coming from certain assumptions. So 4 analysts or 4 different money managers house will have a different perspective. The moment assumption changes, then you have positive or negative surprises. So we don't believe that. Do you say that we ignore that? No, we don't ignore that. But we use these data points, let's say a forward-looking earning or consensus call, as an additional catalyst. It can be act as a trigger. A lot of people market look as a trigger. So this can be a catalyst, but not form the part of the base models.
Okay. You also look at a fair bit of macro, global macro.
Yes.
And that's it's not surprising, but the bulk of the mutual fund managers or industry that we speak to, they say, well, macro shacro, let's keep that aside. Doesn't matter. What matters is what the business is worth, and you're able to calculate it and give some value to it. But your approach is different in that sense. Macro is a very important variable for you.
See, when we talk about, I agree industry, we have worked in the previous avatar as a broker, people only look at the bottoms up, okay? But we are a top-down house. The advantage of a macro data is that we get a much larger perspective. The canvas is far bigger. So from very large macro, we come to micro. So if you give example, okay, if you talk about, let's say example, the largest company, let's say Reliance Industries, okay? If you don't have a perspective on where crude prices are heading, okay? If you don't have a perspective of the currency price, I'm just giving for example's sake, okay? Then it's very difficult to visualize the earnings. Look at the IT companies when the hedging was not proper. People used to consider 5% depreciation over a period of time, okay? Which has become now, you continuously take certain depreciation, oil prices will continue rise, rupee will continuously fall. This assumption has worked in the past when we were emerging market economy. Now we have much better economy, or rather more mature economy. That perspective has changed. It doesn't work. So if your certain assumption which you have built the entire thesis is wrong, and if you can't predict those things, and you're assuming this will happen, so by default your earning assumption or revenue calculation, everything is wrong.
Sandeep, whenever I've met you and I've spoken with you, you've always emphasized the importance of behavioral sciences, and that's an important input for you in that sentiment indicator that you look at. Can you use an example to explain how you put it into use?
See, frankly speaking, Prashant, when we talk about markets, we always talk about fear and greed aspect. Okay, people can feel whether the greed has intensified or we are seeing a capitulative phase. Can you quantify? Okay, now through the help of macro data, we can actually quantify with the help of predictive analytics. We can quantify the macro thesis. And let's say talk about gold or crude. In multiple occasions we have done it. Yes, we can quantify the intensity of greed, intensity of fear. Let's talk about, let's say you as an individual have certain characteristics of your fear, greed, anxiety, frustration. I may not be able to quantify an individual, but an asset classes as well as particular sector and stocks we can quantify, because we look at the cumulative effort of the society where the masses role also play. The behavior of a FI or institution is slightly different from the behavior of retail characteristic. So we try to decode these mysteries and create some numbers around that. And it is a continuous process. So we can see whenever we see a capitulative move happening in a particular sector or some sort of euphoria getting built, like a lot of people say there is a euphoria. I keep on highlighting that we have not seen a classic euphoria which is required for market to peak out. Okay. That feeling has not come in. Now you can feel it, but I can quantify it. So it can be quantified with the help of macro data as well as the micro data.
So I think one area where there is, maybe euphoria is the wrong word to use for it, is the huge participation of retail. And who better than you to actually talk about what we are seeing out there in the markets, right? I think, what is it last AUM? 53,000 crores?
Yeah.
And how many folios?
54 lakhs folio we have.
54 lakh folios, which means that many investors. I mean, with some duplication, but more or less.
More or less.
I mean, that's a very large number. Yeah. What do you make of it? I mean, and you've been, by the way, this is the latest avatar, Quant Mutual Fund, and what you're doing. You've been in the markets for 30 years. Okay. Have you seen anything like this?
No, this sort of phenomena we have not seen. But I tell you, let me give you a perspective like how you have evolved in the last 15, 20 years of your career, maybe in the last 30 years I have evolved. We have evolved with mistakes. Okay, if you will say, people say, okay, you manage money and your success rate is high, but I can tell you all this VLRT framework, everything get built with mistakes. Not mistake, I use the word
What
blunders.
works, what does not work?
So we have built these theses around mistakes. Now same thesis I'm extending for retail. So when you look at retail in 2000 or 2008 in that period when they were relatively young, okay, and they typically come at the peak of the cycle.
Correct.
Okay, retail has come at the peak of the cycle. In Hindi we say गाँव को थोड़ा respect देने का है. गाँव comes or retail comes at the peak of the cycle. Is a contrary indicator. When retail participation is high, market peaks out.
Correct.
Now that phenomena has changed. In last 10 years particularly, I have seen that the behavior characters has changed, and it has changed a lot post, if I have to talk about post-COVID. Okay, when they were on vacation period sort of thing, they analyzed their portfolio, they were early participant. And now they are actually a beneficiary of whatever phenomena of GDP or the macro picture which is changing, and they have understood they are there from longer term perspective. They have understood.
And from a fund perspective, you are actually seeing that.
Yes,
some of the highest inflows that you're getting is on down days.
Yes, down days.
Right.
So market has become so mature, a participant becomes so mature in down days, retailer is able to participate much more.
Correct.
Okay. And in the normal days, we see less flows.
Right.
So it's very interesting thing. Typically, otherwise used to happen at the bottom of the cycle, people capitulate and they will withdraw money and go. Now reverse is starting. That's the reason I say this rally, which is happening right now, is led by retail and has more legs because the size of retail which has.
Sandeep, let's talk about your thesis for the market for India, because you're a top-down. What is the thesis for India from here, in your opinion?
So,
when I say India, I mean from a financial market point of view.
So from India perspective, if I look at Prashant, the way right from 2023, I said that years belongs to neglected zone stocks, most hated zone stock. If you really look at from a growth versus value debate which keeps on happening globally, the cycle which started in August 2012, the growth at any price, that lasted till September 2021. Okay, the cycle peaked out. After that is the value thesis which has come back. Now I'm not saying that entire move is going to be a linear move. Okay, within that you will see some cyclical up move or cyclical down phase also. But our portfolio is now more pro-cyclic, pro-value. Why I'm saying that? Because
which is hard assets.
Hard asset. Okay, we strongly believe that the perception which was there, okay, for these, if I have to, let's say in September 2021, there was a euphoria. And if you dissect the euphoria, you find the euphoria was in new age, technology company, growth company, not in value, not in infra name. So I think that
but we've come a long way from there.
Yes,
right? I mean,
but still, this our view is that value as a thesis has a potential to last for a decade. It's a decadal view. Okay, and then look at the PSU moves. PSU is the classic representation of value thesis. They were beaten down.
Is that the highest weighted sort of space for you?
For us, is a very large weightage. We are relatively.
I mean, if you define by ownership, would you say PSUs are your?
Yeah, it may be closer to, some schemes are 18 to 25% of that portfolio will be in PSUs.
Okay, and do the moves make sense? And we're talking about banks, or we're talking about PSUs across the board?
We have banks also, but the percentage is very small as compared to 2 years back.
Okay.
Now, earlier 2 years back, the
so
banks...
So it is PSUs ex-banks largely?
Largely ex-banks, largely ex-banks.
But there also, I mean, some of the moves have been phenomenal. Railways as a sector, there's defense as a space.
We have a large ownership in railway stocks in our portfolio.
And you're comfortable owning them?
Comfortable. Because you have to look at the thesis which you are bringing. When something gets changed, okay, when you say one perception of the most admired territory gets shifted, the shift, even let's say 10% of the money shift from admired territory or the most admired stocks towards value stock, the money is very, very large. Like when I say, let's say, why I'm slightly more cautious on US, we always say that developed market risk appetite has peaked out, okay, and liquidity will shift. So how money shift from high risk to low risk environment. If 10% of money shift from US to Asia and India in particular, there is tsunami out here. Something similarly, look at in last many years, last 10, maybe 1 decade, a large portion of concentration was confined to see these admired territory stocks. If 10, 20, 30% money shifts from that territory to this value as a thesis or neglected zone stock, there is tsunami, okay, and we are already witnessing that phenomena happening. And where is the over ownership, okay, as compared to 2 years back, they were neglected, hated zone, but they are still not reached the admired zone.
But valuation-wise, I was looking at names like RVNL, etc. Now they're trading at 40, 45 times
So I think
earnings,
you have to
which
do
is
sector rotation, stock rotation. I'm not saying that one particular stock you have to participate. Like we were very early in PSU banks, we monetized that opportunity. Now we are somewhere else. So the sector rotation thesis, stock rotation thesis, you have to play to manage your risk.
But you're saying there is enough to rotate into.
Yeah,
because at
enough
sometimes one feels that rotation तो सब तो हो गया अब कहाँ अभी कहाँ rotate करें?
I will not take the name. Look at the top largest PSU companies. I'm telling you, if you look at top 3 in terms of market cap, where is the ownership?
Right.
The largest public sector enterprise, the free float is 3.5%.
Not banks, right?
Not bank. It's not a bank. But where is the ownership?
Okay.
Okay. It's one of the large bank company available, not valuation wise very expensive. I'm just giving example. And similarly,
I want ONGC and
they're Coal India, they're ONGC, they're LIC. You know, top 3 names are these 3 names you will get. Okay, where is the ownership in these names? On a relative basis.
You own all 3?
Yeah, we own all 3.
Okay.
Our portfolio is already disclosed, so we can talk
and
about
bullish
that.
about.
Yeah, we are quite constructive on this space. Okay. See, we believe metal and mining as a thesis, which we started in 2023. I think will continue in 2024. PSU as a thesis will continue. So then you look at PSU and mining put together, and a PSU mining company will do even better because overall PSU we are constructive as a theme. Then we are constructive on mining from a global perspective. We are very constructive. We think
I think Hindustan Copper is something that you own in your funds.
Yeah, it is one of the large holding in our fund in a small cap. We bought at very early stages, but we are holding it for the last 3 years.
And
now.
that came off a macro kind of a call.
Yeah, for macro call. It's a call on EV, it's a call on copper. We took a call that copper will be in shortage. So how you play? Overseas investment you can't make given the restrictions right now. So we felt that Hindustan Copper was, let's say example, say, was the best space which was available. That's why we were holding for nearly 3 years now.
PSU defense names, you're out of it?
We sold most of them.
And banks as well, you've kind of
We have
gotten
pruned down. We have pruned down. We still have
Railway also you own, but you kind of are.
Yeah, but that railway
it's a
size
small
is not
size.
that big. Within the overall portfolio, the weightage is very tiny actually.
Right.
It cannot be very substantial from these levels.
Got it. What else? I mean, apart from the dire PSU kind of space.
We like pharma as a thesis. We were very early, right from February, March 2023. We have been saying the pharma hit the most neglected zone after what we saw in 2015. In 2015, it peaked out somewhere in March, and then
This is US generic.
US generic in general also. In general, I can say healthcare, but US generic in particular, if I have to talk about, that's a space I think has a lot of potential. That cycle actually bottomed out. So we are constructive on multiple data points. So that's a sector I think, if you ask me, valuations are not expensive. Okay, it is relatively under-owned. It has potential to give you a phenomenally better returns from the current level. So, and downside is limited.
Okay. What else? I mean, there's themes and sort of, top-down conviction where stocks are also attractive. Any other areas?
I think consumption is also coming back.
Okay.
So consumption is an early areas which we are looking at now.
You mean low-end, the lower
because
end?
rural economy is coming back. So I think with a lag effect, because if you look at last 2-3 years, consumption names have not delivered much. I think that cycle is bottoming out. We are looking at more data more closely to identify.
And what's the
some
best way
stocks.
to get exposure there? I mean, if that...
Staple could be name, food companies could be a name we will look at, but we are still working on it and trying to gauge. Maybe this quarterly number will give me more perspective, is not only from the festival point of view, but overall where the trend is changing. So next 1 or 2 quarter, will we be able to gauge the COVID effect which happened or the logistic challenge in inflation which came because of the constraint on the logistics side. I think that's a easing out. If it eats out further, I think that's the one area which we...
IT services?
We are not negative on IT services, but only problem is that we are not very constructive also. Okay, so for us is the, you will not lose money, but I'm not sure whether we'll make
You'll make a lot of money.
Okay, so...
Because you're not very bullish on the US.
Yes.
I mean, as a...
Yes, we are not very bullish. We think the BFSI spending is coming down. So overall bench is very high. Body language of the the management on this space is not very good. So if I look at IT versus pharma, I think I'll prefer pharma over IT. Okay. The clarity is far better in pharma names. Okay, on relative. Yes, if you ask me whether downside is there in IT, I think our downside is limited. Okay, pharma is more volatile because of FDA related challenges. Sometimes you see unknown risk knocking your doors. So those are the things you have to keep in mind. But if you look at the larger bouquet, I think pharma is a basket.
Is where you'll make more money compared to...
We are very significantly overweight in that
One
space.
name which you, I don't think have own in your portfolio is HDFC Bank. Or I mean, why is that?
No, it's not. Currently, we don't own it.
I mean, you used to own it.
Yeah, we used to own it.
But private banks is something which, I mean, the street is extremely bullish on. It has been bullish for a while,
Yeah.
but that has not worked for some time.
So this is the same answer I'll give you. If you look at the pure valuation aspect, valuation was attractive. Everybody was talking about it. It was a very consensus trade for a while. But if you start looking at the risk appetite data or liquidity analytics for the sector as a whole, then you realize some of these names actually peaked out way back in September 2022 itself.
When you say peaked out, you mean?
Reached out a peak. Okay, when I say peak out, not in terms of prices, like risk appetite was the highest between September 2022 till September 2023. So risk appetite has peaked out, which means there is no urgency to buy for anybody. Okay, liquidity cycle is actually shrinking. Okay, so if liquidity is declining, so it's a bad combination. See, other way, when liquidity cycle rises and risk appetite is rising, you make more money. When otherwise it happens, okay, so risk appetite peaked out, liquidity shrinking is a reverse combination.
Sure.
So that's the area we try to pronounce. So we maybe what? I think overall we have only 3.8% weightage in the banking as a whole, in the entire portfolio, depending on scheme to scheme. So we are grossly underweight on the banking side.
And that has worked wonderfully well for you.
So far it's worked very well.
It has worked.
But again, it's a data-driven approach, not on the.
And if the data changes, you will.
We have no problems.
But as of now, it's not showing any signs of
so if you
changing
ask me
or turning.
from a near-term perspective, maybe we have seen a massive sell-off, so maybe pullback rallies can be there. But to take a decisive call, I don't think they have reached those neglected zone where we get like what was Pharma in February, March, okay, or IT was in September. I don't think they have reached that phase where we will say go all out and increase the exposure. And again, it's a consensus trade, grossly overowned space. Okay, so we don't mimic indices. So we are very active money manager. So I look at industry closely. A lot of people look at closer to the benchmark allocation. We don't do that.
Got it. Is the market in fine shape, Sandeep, or you think we should be ready for a little more volatile 2024? I mean, ups, not just ups, which everyone is just used to, and some downs as well along the way. What's your sense?
So let me give you larger thesis. We have been saying India, this decade belongs to India, maybe half century belongs. Manufacturing is a cycle. Larger thesis I'm talking about looks very good to us. Anything, and again, so manufacturing is a very large thing, manufacturing, infra, as a space is doing very well. But again, as compared to maybe 2023 return, because everybody was very skeptical in the beginning of 2023, and obviously returns are far superior, you may not get something similar performance. But we are still very constructive on the entire India space. I have been talking about that we are in bull run, very decisive bull run. We are still in bull run. But easy phase of bull run is over.
So you crossed the 50% mark.
Maybe in certain sector, maybe certain stocks could be answer is. But if I have to look at summarize in the thing, I think maybe in 2024, at least I expect 24,000 nifty. That's sort of the minimum what I'm expecting this year. It's still a good growth. Correct. In terms of return perspective, is a good number. I don't think we have seen a stage which is very classically euphoric, where we need to be worried about. But stock rotation, sector rotation is the thesis which we play, and that really help us in reducing our risk.
As you said, the easy phase probably is behind us. Sandeep, it's a pleasure having you with us here on CNBC-TV18.
And covering us.
Keep delighting your investors. Look forward to more conversations. Thank you.
Thanks, sir.